I'm sure you guys are aware of plenty of dividend stocks out there, but today we're going to be talking about 4 to buy and hold forever. And the best part is you don't have to do anything to get this money. As always, stock market investing can be risky because you can lose money. These are just my opinions, so I encourage you to do your own due diligence. If you're looking for a way to start creating passive income and start getting closer to financial freedom, then dividend investing might be just for you. Dividend investing can provide safe and rapidly growing passive income, and that's why it's become the quickestly most popular form of passive income. It's taken me several years to learn what I'm about to share with you in several minutes. So if you like learning about investing, or you're here to review what you already know, consider subscribing so you can get the latest content as soon as it drops. Now, a quick overview of what dividends are. They're basically a reward to shareholders for investing in the company, and it's usually paid out of the company's net profits. The nice thing is some companies continue to pay dividends, although the expenses don't justify paying the dividends. Companies generate revenue, and part of the revenue becomes profit. What can they actually do with that profit? Well, they can actually put it back in the business and continue to grow and innovate, or they can choose to buy up other companies, or they can choose to reward their shareholders. So every company we're talking about today chooses to pay out a part of their profits to shareholders in the form of dividends. Now, for this dividend stock video, the criteria to be recommended is a minimum dividend yield of 2% per year. If it's less than that, personally, I wouldn't consider it a high dividend yielding stock. And since we're looking at stocks to buy and hold forever, it's extremely imperative that we choose a basket of stocks from different sectors. Because, as you know, the economy is ever changing. We're constantly going through different cycles, where sometimes technology stocks will do better than, let's say, consumer discretionary. Enough talking, let's get started. The first stock we're going to be talking about is Texas Instruments, stock ticker symbol TXN, which designs and manufactures chips, but not the chips that we eat. Today, we're actually talking about processor chips. Currently trading at a price of $190.40, not only do they pay a high dividend yield at 2.8%, which means, by the way, for every 10K invested, you'll get back $280 per year just in dividends, but the share price has increased by 52% just in the last 5 years, coming up all the way from $126. They've had a phenomenal past 10 years, been able to multiply the share price by 3.5 times, coming all the way from $55 in December of 2014, which is quite impressive. Looking back 20 years, they've actually multiplied their share price by 7 times to get all the way to today's price of $190 per share. A 10K investment would now be worth $77,000. The best part about all of this, the $77,000 that you now would have had after 20 years doesn't even include the dividends that were paid out for the last 20 years. If you include that, reinvesting those every month, now you're looking at a 6-figure balance. And while they do have an impressive dividend yield, it's actually the dividend growth rate that's impressive about this company. What is a dividend growth rate? It's actually an annualized percentage of rate growth that a particular stock has experienced over a certain period of time. What does that mean in layman's terms? Say you start off with $10,000 and you invest it, and at the end of 5 years, you have $16,000. Well, that's a growth rate of 10%. How did we get to that? Well, in order for your money to have reached $16,000, it would have need to have grown by 10% in each year of those 5. For Texas Instruments, the dividend growth rate is sitting at 10.5% over the last 3 years. The 5 years sitting at 13.7%, and the 10 years sitting at 18.2%. That is actually absolutely phenomenal growth, and it's the exact reason why we're looking at these types of companies. At 95% payout ratio, this company is actually going to be the highest percentage of payout ratio on this list today. Is that good? Is that bad? I mean, what is even a payout ratio? It's actually a financial metric that's used to measure the sustainability of a company's ability to continue paying high dividends. So why is it important? Well, it provides insight into the company's earnings distribution strategy, so we can see whether the company prioritizes reinvesting into the company or reporting its shareholders. So how's it even calculated? Well, you take the amount of dividends paid to shareholders and you divide it by the net profit of the company. I generally like to see a payout ratio of 60% or less, because typically the lower the payout ratio, the better chance a company has at paying me out high dividends every single quarter. However, when it comes to Texas Instruments, I'm not worried, because looking at the 24-year history, they've actually increased their dividend quarter over quarter for the last 24 years. Let's move on to number 2, which is going to be in the home improvement industry. The reason why I'm so interested in this industry, and you should be too, is because the average age of a home in the United States is over 30 years old, which means a lot of things are breaking and you're just going to constantly needing to repair them. So the home improvement industry is just going to soar. As the largest home improvement retailer in the United States, the company I like here, you guessed it, Home Depot, currently trading at $413.75. They not only pay a high dividend yield of 2.11% per year, which means for every 10K invested, you'll get back $211 per year in dividends, but the share price has increased 93% just in the last 5 years, coming all the way from $215. They've even had an awesome past 10 years, multiplying their share price by over 4 times, coming all the way from $80 a share looking back at December 2014. And if we look back 2 decades, we're even more impressed by looking at the share price that was $42 in December of 2004, which means that the share price has multiplied by 10x, which means that a $10,000 investment would now be worth $100,000. Now, that's not even including the dividends that were paid out every quarter for the last 20 years. Let's not even run the numbers from what a $100,000 investment in Home Depot would look like from 20 years ago. I'm sure you're aware it's over $1 million that you would have today. Home Depot's dividend growth rate for the past 3 years is 10.89%. And for the past 60 months, it's 10.59%. And the 10-year is sitting at 16.95%. Their payout ratio is 60%, which is decent. Their company is very impressive. And if you're shopping for home improvement, you're really only going to 1 or 2 places, Home Depot or Lowe's, which is a very impressive stock as well. It just pays a little bit less of dividend yield at just 1.7%. But it has very similar 5-year, 10-year, and 20-year stock returns as far as share price when looking at Lowe's compared to Home Depot. So if you shop at Lowe's more often and you feel more comfortable with them, feel free to invest in Lowe's instead. Or even better, if you want diversification, invest a little bit in both. Moving on to the next company, which, like Home Depot, happens to also be in the consumer discretionary sector. With over 40,000 locations worldwide, we're talking about the premier retailer of coffee, Starbucks. Currently sitting at a share price of $98, it's no wonder how Starbucks has been able to multiply their share price by 2.5 times over the last 10 years when you take a look at the customer that goes there. I mean, some of these people will put Starbucks over basic necessities like food, water, even oxygen sometimes. It has a dividend yield of 2.47% per year, which means 10K invested will come out with $247 in dividends per year. The share price has increased by 11% over the last 5 years. And I don't really have to convince you that Starbucks is here to stay. But the reason I really like this company is over the past 20 years, the company's share price has multiplied by 6.5 times. So a 10K investment 20 years ago would be sitting at $65,000. That's not even including the dividends that Starbucks has paid out this entire time. Starbucks' growth rate is 8.03%, and we're looking at 9% over the last 5 years, and the 10-year is sitting at 15.48%. Their payout ratio is 68%, which is not too shabby. The next company we're looking at is in the financial sector. We're talking about JP Morgan Chase, ticker symbol JPM, which is currently trading at a share price of $241.53. This company has a dividend yield currently sitting at 2.06%. Looking over the past 13 years, we can see that the company has been consistently increasing their dividend payouts from a starting point of just 5 cents all the way back in 2009, climbing all the way to the most current dividend yield of $1.25 per share. Over the past 5 years, this stock has not only paid great dividends, but the share price has gone from $136 per share in December 2019 to its current share price of $241.53, making investors 77% from share price growth alone. Over the past 10 years, the share price has multiplied by 4. And if we go back all the way to December 2004, we can see that the share price has multiplied by 6 times, meaning a $10K investment would now be worth over $60,000. That's not even including the dividends that were paid out. Had you reinvested those dividends every quarter, your investment would now be worth in the 6 figures. The payout ratio is currently sitting at a low 28%. So they have plenty of room to grow those dividends in the future. So if you guys are looking for some exposure to the financial sector and a company that pays out great dividends, then JPM could be a great choice. Anyways, that's it for today's video. I'm sure you guys are aware dividend stock investing has been growing and growing in popularity. It's because they're more resistant to the ups and downs of the stock market, and they pay out a consistent income, which is something that a lot of people value right now. As always, these are just my opinions and my experience, so I encourage you guys to do your own due diligence. That's it for today's video. If you guys liked it, please hit the like button and remember to subscribe for more content. Thank you so much for your time, and I'll see you on the next video.